Hello and welcome to our brand new show, Markets and More. Is investing an art or science? That's debatable. But what is not debatable is to be a good investor, you need to have experience, understanding of market cycle, and ability to understand the market positioning and then blend that with valuations to make superior returns. Well, it's sounding very complicated, but the attempt of the show is to really simplify the jargon of investing. How can one really make money by simple ideas and by simple application along with risk management? Now, the guest on the show today is someone I've interacted with for over 2 decades now, and he's got more than 3 years or 3 decades of experience. When I first met him, that is Sunil Singhania, he certainly looked different, but he's looking much more different and much more experienced now. Sunil, fantastic to have you on this show. So we would be in this new show, we would be doing a monthly show with you, and we'll just take you out of your comfort zone to talk the non-market stuff as well.
Thanks a lot for having me. Look forward.
The first segment, we would be focusing on the key trend or the current topic. And the current topic, 6 weeks ahead of election, has to be elections. But before I get your thoughts on election, Jayesh is going to tell us that is there a correlation, connection, and historically, how exactly have Indian markets moved before and after the elections? Jayesh, take it away.
Well, what we have done is looked at how the Sensex has performed in each of the election years beginning from 1980. Yes, so we have about 10 data points to refer since 1980 and how the Sensex has performed during the election years. And what actually stands out over here is that during 80% of those 10 years, the Sensex has given you a positive return on a full calendar year basis. There have been 2 instances, one in 96 and the other one in 1998, wherein you had a mild negative return that was delivered by the Sensex. But overall, the median return over the 10 years that we are referring to, that has been in excess of 20%. In fact, the maximum return that was generated was in 1991, wherein the Sensex surged as much as 82%, and the positive return has been about 80% of the times. So definitely, investors and traders who have the conviction and the patience have definitely been rewarded, irrespective of the noise and the volatility surrounding the elections.
Sunil, Jayesh has pointed out very simple and interesting data, which is that in the short term, markets may act and react to election verdict, but in the long term, they don't. Now, you know it, I know it, and now our viewers know it. But despite that, there is a lot of uncertainty, anxiety, and anxiousness ahead of election cycle. Why is that?
So I think, as human beings and as very, I would say, very aggressive or day-to-day monitoring kind of investors, we get worried about everything. So it's not only elections. Actually, if you see the last 1 year, there are so many challenges which we have got worried about, whether it is, US, Korea, US, China. We had 3 state elections, we had long-term capital gains, we had oil move up to 85, we had rupee move up to 74. So elections obviously a big thing, but every event, as investors, we tend to get a little bit too, I would say, overcome by the near-term effect. And obviously elections is one in a 5-year kind of an event. It is widely monitored. It is also widely highlighted by media as well as all the other agencies, because it's crucial. It's a direction to the economy for the next 5 years. So it's very obvious that in the near term, there is too much micro analysis which gets done as far as the election is concerned. But as you rightly showed, last 6-7 elections at least, which I have been monitoring on a regular basis in my investment career, on the day of the election, there is obviously some knee-jerk reaction on either side. But ultimately, markets stabilize. And the last 3 elections in particular have been very interesting because the verdicts were surprising. So in 2004, Congress and left surprisingly formed the government. We had a knee-jerk reaction down, but it turned out to be one of the best times to invest. 2009, again, there was I would say the Congress got re-elected. There was some surprise. And again, you had a good period. 2014, you had a big up move on the day of the election because of the surprise one-side verdict. But ultimately, in all these 3-5-year periods, the returns have been approximately 60% odd, which is mirroring the nominal GDP growth rate.
Now we'll talk about that 60% up move, but first let's understand how should one position their portfolio in the run up to the election. And you said that markets will move depending on what is in the price. Now there are three scenarios. One, return of the current government. Second, return of the current government with an outside support. And C, or the third scenario, is that complete change of guard. So what to your mind markets are pricing in?
So obviously the markets, the way they are sort of taking a call is a perspective that there is going to be continuity as far as the government is concerned. That is quite clear. Whether they are pricing it or whether they want it from their hearts, that is debatable, but very clearly that is what the markets are pricing. And at the same time, one interesting aspect, and which is good, is that there is some sort of a view that it might not be that easy. So markets are pricing in return of the government, but maybe they are not pricing a one-sided return of the government. There is still an apprehension whether it is 250, 260, 270, 280, and there is some fear that it's not whether the ruling party will come back or not. I think the fear is only one, that if we have a completely disjointed government. So I think that is going to be an extreme event. I think in that kind of an event where it's a very, very fragmented kind of a mandate, where you don't know who's going to be the prime minister, which party is going to sort of dominate the ministries, that would be a disastrous kind of a scenario. I don't think the markets are pricing that. All the other scenarios, pretty much I would say the markets would be pretty okay with. I personally believe that this time we are not going to have a very big move post-election. I don't think we will have a 10% down or a 10% up.
Irrespective of the verdict.
Except the one which which is like a tukde sarkar or whatever you call it, Except that, I think everything else will have a sort of a much more muted kind of a move either side. But what it will do is it will take away the uncertainty. So I was in the US in March, and even when I move around in the country trying to sell my funds to investors, I noticed that there is this huge capital which is lying at the side waiting to be deployed. And as I mentioned to you earlier, in the last 1.5 years, you have had too many news flow based challenges which has dissuaded investors to invest further, and the returns have not been all that great too. So that capital pool is waiting to be deployed. So maybe post-election, as stability sort of comes back in terms of news flows, you might have that capital pool start to move into the markets.
Okay. If markets fall 5, 10, 15% post-elections, you will be a buyer.
I would be a buyer, irrespective, frankly. And obviously, if you have such a huge fall, we have seen that news flow based falls have turned up into the best opportunities in India to buy. We had that in 2009, we had it in 2004, we had it during Brexit, we had it during the US elections, we had it during demonetization. So I think any event which has caused the markets to fall by 10-15%, in hindsight have turned out to be one of the best opportunities to buy. But with a disclaimer that in the very, very like a 2% probability of a very fragmented verdict, then we'll have to just evaluate whether there will be continuity of the economic policies.
Okay. So before we take a break, can I say that the big learning for you in last 30 years has been that event-based sell-off should always be bought into?
100%. I think this nation has grown consistently. The growth rates from 5% have moved to 6% to 7% and hopefully to 8%. The economy took 60 years to reach $1 trillion. At 70 years, we are $2.5 trillion. We believe that at 80 years of our age, post-independence, we should be anywhere between $6 to $7 trillion. So the wealth which we have created over the last 70 years, twice of that is going to be created over the next 10 years.
So second lesson, first, buy event-based sell-off, 10 to 12% Nifty return or benchmark indices return cannot be ruled out for next 5 years, which means that if you have a 5-year view, equities will still do reasonably well and they have the potential to give the best return.
We definitely believe so, and we are very confident about that.
The biggest truism in the market is that markets, they follow a cycle of greed and fear. But rather than focusing on where the puck has moved, one should focus on where the puck will move. So in this segment, reverse swing, and literally I mean that, what we'll do is that we'll try and find pockets where good could become bad, but awful could equally become good. So Sunil, first the easy part. The easy part is that consumer discretionary, consumer durable, some of these haloed consumer brand companies, which Buffett calls them as moat companies, they've been darlings of the market. But you want our viewers, and again at private forums, you've been making a case that investing is not about buying gold at the price of diamond. It is like buying gold at the price of silver. So let's talk about it, because some of these stocks are down. Page, Aisha, Maruti, the correction is anywhere between 30 to 50%.
So very clearly, and you mentioned Warren Buffett, and obviously is a guru, and Warren Buffett himself has said that it's always better to buy wonderful companies at a fair price rather than buy a fair company at a wonderful price. And I think it boils down to that. So there is no denying the fact that companies have moat, companies keep on growing, at a decent pace. Any company which has brand and which has a stickiness in terms of the product which they are in, they maintain the quality and so on and so forth. Having said that, I think the world is dynamic and the world is also changing. The second thing is that there are options available, and also because so much money has gone over the last 2-3 years in this so-called safe companies. What I mean by safe companies is where the growth rate has been predictable. There has been no surprises in terms of earnings growth. I think those companies from 20p became 30p, became 40p, and then they started to trade at infinite p of 60, 70, and investors just did not bother about those valuations. I think in these companies the risk is that a 1 or 2 quarter slowdown punctures the complete P. And it is not about the earnings going down, but it is the P from 60 going to 40. So some of the companies which you named, they are great companies, but the problem is that the P from 60 has become 40, and therefore you are looking at 35% fall in the stock prices. So again, just to highlight that we are also proponent of the great consumption story in India. But at the same time, at least my perspective in life has always been that what are you buying at what price? Because ultimately when you are buying or investing in a company, you are technically becoming a partner in the company. So if XYZ company were to available 100% to you, would you buy that company completely as a business? If the answer is yes, then you should be investing.
How do you judge fair value? Because PE could be one benchmark. I mean, HDFC Bank has always traded at price to book of 4 times, but on a P multiple, it has never traded at P multiples 50, 60 times.
So for sectors, it will always be different. Obviously, the financials tend to get traded at a price to book, but recently we have started to see that ultimately investors have realized that these are like other businesses. You should look at them from a PE basis, because good financial companies have been able to raise capital at will. Whether it's HDFC Bank or Bajaj Finance or some of the other well-known financials, for them capital has never been a constraint. So it's not fair to look at them from a price to book value, because the moment they raise capital, the price to book value ratio just gets skewed towards the downside. Having said that, you did mention, and even I like a few companies which are high P, but then the growth has to compensate for that higher P multiple. So I think if you look down, say, at a company which is trading at X today, and you're paying a particular value, how much is it discounting in terms of growth, in terms of longevity? So, so like there are companies where the volume growth is 5%, which are trading at 50 times. Frankly, I would never buy them.
But what is the benchmark you use? What is the P and what is the growth which will justify this combination?
So, for example, beverages is a very dear sector for me, especially the beer side. There what we are seeing is that there's a double-digit volume growth. The company is gaining market share, and the profit growth can be significantly higher than the volume growth. So, and there is a lot of stickiness, because there cannot be disruption. If you have to drink beer, you have to drink beer. You can't take a tablet. Launching new brands is very tough because advertising is not allowed. We are a young economy. Just to give you a perspective, 20% of all human beings born in the world after 1st January 2000 are Indians. 20% of all human beings born after 1st January 2000 are Indians, and they have still not reached the drinking age, where it is now much more socially acceptable and all.
A theme which you've liked, and where some would argue that there is a bit of a fear now, is cement. Couple of years ago, the positioning in cement was strong, that India will start rebuilding itself, plants will start retooling themselves, and the demand for cement would be linear. But cement has not been a big money maker.
So I would combine, the EPC companies and the so-called construction companies to some extent, capex companies and cement here. As you rightly said, money has not been made over the last 4-5 years for a multiplicity of reasons. Even in EPC companies, balance sheets were completely messed up. Construction companies became asset owners. So they diversified from their core of being a contractor to becoming an owner of the asset. The balance sheet got screwed and the interest rates went up, capital was not available, and their whole cycle turned negative for them. I think one interesting thing over the last 2-3 quarters what we have seen is that the EPC companies also have started to have a little bit of discipline as far as their balance sheet is concerned. So yes, we have had the highest backlog of orders ever for the whole sector as a whole, and the way both the manifestos of BJP and Congress talk about future infrastructure growth, there is no reason not to believe that this growth in order book is only going to increase. Also, the number of companies in existence have reduced because the fly-by-night operators or the companies which are not able to manage their balance sheets have all disappeared. Third is, companies have also realized that if you are a contractor, be a contractor. Don't go in for becoming an asset owner. So that diversion of capital into assets which are longer gestation is now behind us. Fourth, which companies which have some assets are able to sell them because the Canadian pension funds and a lot of large PE guys are willing to buy those assets.
Duties over ham has come back.
Yeah, and you are seeing ROEs for the first time, even in EPC companies, standing up to 15-17%, which is like a dream, And because of the bad past experience, investors are ignoring them. At least my view is that it makes sense, specifically looking at the huge, spending which is going to happen in railways, on airports, even on roads, inland waterways. We are again talking about linking of rivers and so on and so forth. Cement is sort of a sector which has a lot of promise, but which unfortunately has never been able to deliver consistently. So there are 3-4 companies which have been able to deliver very consistently, but a vast majority of the smaller companies have not been able to deliver. Having said that, I think things are now sort of changing. The intensity of capacity addition is reducing. And for a change, after 2-3 years, we are seeing volume growth for 3-4 months consistently trending up at 7-8%. Now if you actually look at the dynamics, to set up a new cement capacity of say 1 million tons, you need 600 crores on an average, 500 to 600 crores. So unless that company makes 100 crores of EBITDA, it doesn't make sense for the capacity to be set up, which means that you have to generate 1100-1200 rupees EBITDA per ton, whereas the companies now are generating anywhere only between 500 to 600.
Now let's look at something which I always enjoy reading, your notes of what we are reading and what we are watching or what we are seeing. You've read the manifestos, and finally, if I change the names here, the economic policies with a little bit of sugar coating here and with a little bit of salt coating and a sugar coating there, they're not different. So how should one judge based the ideology based on the manifestos?
Frankly, after the last 5-6 elections which I have tracked, I don't remember the manifestos of any party for any of the elections. So obviously manifesto is a public statement. I would say that it remains fresh only for the 2 days after the manifesto is declared, but again, if you look at the inherent economy, I think no one can deny the fact that we are one of the youngest economies in the world. No one can deny that even if we don't perform to our aspirations and to our potential, we'll still grow at 6.5% because that is the inherent growth which our young economy brings in.
Now, a couple of 2 more things, and then we'll wrap the show. You've mentioned in one of your notes that the delivery food business is changing. At least I can speak for myself that we use a lot of delivery apps. How will this change the restaurant business? Is there a sunrise theme in making? Is there money to be made? That's the idea of the show, markets and more. How can one make money? How can one make money because of this trend?
So unfortunately, India is one country where Indians have not been able to participate in these upcoming sectors. Largely because one, we always say that India is not an open economy. I think India is too open an economy. And as a result of which, the Amazons of the world and the Ubers of the world and the Googles of the world have unrestricted applications and businesses here. You look at China, where they have restricted, and therefore you have the WeChats and the Alibaba and the Tencents operational there, and the investors have been able to make money. Unfortunately, in India, we have not been able to do it. And even the Indian new generation companies like Flipkart and Ola and OYO, they are all on the
in
private
private
domain,
domain, all in
and you know, they're listed.
So how can one participate then?
So I think you have to do it now indirectly. Unfortunately, there are not too many direct players. There is one half internet companies, but most of it is indirect players. Having said that, you touched upon this delivery business. I think one lesson over the last 5-7 years, and which again is a part of our meets framework which we follow, is that you cannot ignore events and trends. So you might not be able to buy directly, but you should also as investors be aware that what you should avoid, because it is possible that disruption might happen in a company or a sector, how good that company or a sector might be. So you know, if electric vehicles were to become mainstream, a lot of auto component companies, particularly focused on engines or carburetors or so on and so forth, will be out of business. You know, we saw what has happened to newspapers. You know, they are still being read in India, but the growth rates have become either zero or negative because people are moving to video and the online function. So I think if we can't invest, at least we should try and see where we can avoid, and I think that is very important. In terms of the delivery business, it's a complete revolution. I think it is good for the restaurant business also, because ultimately these are carriers, and you know, I talked to a few guys who are in the restaurant business. In fact, their businesses have doubled because without paying rent, you know, they are able to have additional sort of revenue coming in from these businesses. So I would say that new businesses should not be taken as a threat. New businesses, in fact, will increase the markets manifold.
So if you have to summarize today's show, I think headline number one should be, elections will come and go, your long-term investment planning should not change.
100%. And you know, you have to keep the big picture in mind that over the next 10 years, we are going to make 2 times as much money as we made over the last 70 years.
Okay. Second, avoid expensive stocks, but don't ignore construction and cement as core themes.
That is my philosophy. I would say that an investor should not invest in anything which that investor does not understand. And that is again Warren Buffett's philosophy, that if you don't understand something, don't invest just because everyone else is investing in it. And
yes,
I would
no,
say
I don't know, you follow the I don't know philosophy.
Yeah, and you know, it's okay. You know, you can't expect to make money in every stock which goes up. But my view would be that don't invest in a 60-70 PE stock unless you are convinced that the growth rate is going to be for 10-20 years of a very high rate.
And the third headline which we could say, or the third trend which we could say, is that don't underestimate the power of disruption. The food business has got disrupted. You may not participate in it, but it is an evidence or an indication of what to avoid, so that you don't, your portfolio does not get disrupted because of trends.
You cannot afford to basically not heed to disruption, and I think there is where having you know, kids between 10 to 20 years is always an advantage, because they will tell you what the disruption is. You know, you will never be aware of what the disruption is.
I don't want to discuss your age publicly, but if we get the hint that how old are you, but appreciate your time, and just been so fascinating to, you know, talk about not just markets, but markets and more also. And look forward to this monthly
really
show.
Interesting.
Okay, that's it on this Markets and More show, and we'll see you again next month with new trends and topics beyond markets.